Alright, so this time we are covering Unit 4C, Savings Plan and Investment. So if you remember last time, the final question was if you wanted to have a $100,000 college fund for your child after 18 years, how much would you need to deposit now? And it came in at around $11,000. Well, most of us don't have $11,000 sitting around to deposit into an account. So what usually happens is people will make monthly payments into an account over time. So with a savings plan or investment, we are going to figure out how much you would put in a month to have a certain amount at the end. So A is your starting ending amount. APR is your interest rate again, and is the number of payments. Usually 12 for these because we're doing monthly, and Y would be the number of years. The only new thing is the PMT, that is your monthly payment. Now, realistically, you are probably going to change the amount that you pay per month. Hopefully, you get raises or better jobs over the years. And as that happens, you can add more to your retirement account or your savings account or whatever you are planning for. But those formulas start getting a little bit complicated when the number changes. So we are going to stick with a regular monthly amount that does not change, just for the sake of simplicity. All right, so example one. If you have $100 per month that you put into an account for 6 years with an APR of 12%, how much do you have at the end? So just doing a quick check, we would have 6 years, 12 months, 7,200 months, 72 months times 100 would give us $7,200. Okay, so you've put in $7,200 of your money. Anything above that is going to be interest. So so we're looking for 100 would be the starting amount. Now you'll notice there are brackets and parentheses. Not to say that those are absolutely essential, but if you do not put the brackets and parentheses in, you will get the problem wrong. Okay, I guess that probably is the exact definition of essential. So do not miss the brackets and parentheses. Okay, you absolutely have to have them, and especially the ones in the denominator tend to be the one that people forget. Okay, so the 0.12 divided by 12 in the denominator, if you're going to plug it all into the calculator at one time, you have to put everything in parentheses and make sure the parentheses are in the correct spot. I would recommend just the numerator first and then just the denominator. Okay. That's probably the easier way, but you can try it, but be very, very careful. All right, so we've got 1 plus 0.12 for our interest rate divided by 12 for monthly payments, and raised to the 12 times 6, subtract 1. Once again, when you're plugging into the calculator, make sure that minus 1 is not caught up in the exponent. So it's not 72 minus 1 as a power, 72 as a power, and then the minus 1. So I would recommend plugging the numerator in just one time, getting an answer, plugging the denominator in and getting another answer. And then once again, go ahead and use the exact answers that come off the calculator, because if you round too early, and too early can even be 4 or 5 decimal places for some of these larger ones, you are going to get it wrong with My Math Lab. Alright, so we plug the numerator in the calculator, and we get 1.047099 divided by 0.01, and you have put $7,200 of your money into the account, but your overall amount is $10,470.99. Okay, so just over $3,200 of interest has been added to the account. All right. If you plug in $250 a month for 24 years with an APR of 5%, okay, how much would you have at the end? So 250, and then your brackets and parentheses, 1 plus 0.05 interest rate divided by 12, raised the 12 times 24, and I would times those together and make it 288, and then subtract 1, and then divide by 0.05 divided by 12. Once again, I would do the numerator separate, and that's where you get your 2.31185, and then divide it by just the denominator, which is 0.0417, and you would have $138,711 in your account. All right, so retirement. All right, so Michelle is 30. She starts saving for retirement. She's going to deposit $200 a month. She's getting 11% APR. She wants to retire in 35 years. How much would she have? Okay, so just a quick little thing. So she's deposited $200, 12 months a year for 35 years. She has put in $84,000 of her own money. So how much interest does she get? Well, 200, and parentheses and brackets, 1 plus 0.11 divided by 12, raised to the 12 times 35, and that would be 420 minus 1 over 0.11 divided by 12. Okay, once again, numerator for one, denominator for the second one. And she would have $985,659.27 in her account. So she's put in $84,000, and she has gotten just over $900,000 in interest over those 35 years. Kind of two things with these. Make sure you get a good interest rate for return, but also time is a big one. Okay. If she had started, even 5 years earlier at 25, she'd be well over probably $1.5 million. So start early, even if you can't do a lot. The time is something that's really going to help. The other thing is a lot of businesses will actually match a contribution. So if you're having a showdown at the 401k corral, they want to match your 5%. So just quickly, if Michelle's company had matched her $200, that would have given her a total of $400 a month, but the other $200 came from her company, so she actually still only had $84,000 of her own money in there, but with her company matching it, she's at $1.9 million, almost $2 million, simply by having her company match her $200 a month. So that's a big difference from $1 million to almost $2 million simply by having a company match her over the 35 years. So if your company can match you, go ahead and do it. All right. So let's go back to our college fund. So we want $100,000 college fund for our kid. We have 18 years. We don't have $11,000 sitting around. So we're going to do monthly payments. If we can get 9%, we want to know how much would you need to put in. So in this case, $100,000 goes in for A. We are looking for the monthly payment. 1 plus 0.09 divided by 12 raised to the 12 times 18 minus 1 divided by 0.09 divided by 12. Do not forget parentheses. Do not forget brackets. Okay, once again, I would do the numerator first and then the denominator. So the numerator came in at 4.02264 divided by 0.0075, and I used the answer button on the calculator so to get an exact one. And so coming over to the blue, we have 100,000 equals the monthly payment times $536 0.35167, divided that into 100,000, and you would need to pay monthly payments of $186.44. So if you did 18 years of monthly payments of $186.44, you would have $100,000 in your child's college fund by the time they're 18. Okay, just kind of a side note, $186.44 times 12 times 18 for months and years, you would have put in $40,271.04. So planning is a big one. Do not be this guy. Retiring on Friday, hasn't saved a dime. He is going to be working after he retires. All right, when we do an investment, a couple things we're looking for. We want to know what the total return is as a percentage, and we want to know what the annual return is. So total return is very similar to our percent changes, if you remember those from Unit 1. We're going to do the ending amount minus the starting amount divided by the starting amount. Once again, parentheses are essential. And then times by 100. And then for the annual return, we're going to take the ending amount divided by the starting amount, raised to the 1 divided by y for the number of years, and then minus 1 on the end. Okay, so a couple examples. You invested $3,000 in Clearwater mutual funds. 4 years later, you are up to $8,400. So a very nice return on your investment. What is your what's your total and annual return for the 4-year period? So 8,400 minus 3,000 divided by 3,000. Once again, if you forget parentheses, you will get it wrong. Okay, you've got to put the parentheses, and then times by 100, you get a 180% return on your investment. To find your annual return, parentheses again, 8,400 divided by 3,000 raised to the 1/4 power, because it was 4 years, minus 1, and it comes in at 0.29 or at 29.4% return. Once again, that is a very nice return per year. Now, unfortunately, not all returns or not all investments give you a return. It is possible to end up in the negative. That simply means you lost money. So you purchased shares of New Web for $2,000. 3 years later, you just gave up. You sold them for $1,100. We want to know the total and the annual return. Okay, so you lost money. So you're going to end up with negative accounts. So 1,100 minus 2,000 divided by 2,000 times 100 is negative 45%. And then for the annual return, it's 1,100 divided by 2,000 raised to the 1/3. Do not forget parentheses. And then subtract that from 1, and you get a negative 18.1%. Okay. Now, you should notice that if I take 29% and I times it by 4, I do not get 180. And same thing, if I take 18.1% and times it by 3, I do not get 45. Because once again, you're having interest build on top of interest. Okay, so you're not getting the same amount of interest per year. You're getting the same percentage per year, but you're not getting the same amount per year. All right, so there are really 3 different things that you can invest in. One is stock. It's probably one that people have heard a lot about. And that's when you buy ownership in a company. And a couple different ways you can do it, a couple different ways you can make money. One, you'll get a dividend. So they'll say, hey, for every person that's got a share of stock, we're going to send them 50 cents per dividend. The other way is you can sell your stock for more than you bought it for. That would be kind of the case with Example 5 above us, you bought it for $3,000, you sold it for $84,000. Okay, so you sold it for $5,400 more than what you bought it for. Once again, though, as you saw in example 6, you can also lose money. A bond is really just buying a debt. So I'm trying to think. I don't think there's any bonds coming up on the market on the voting ones. But a lot of times if a county needs to build a new school, they'll issue a bond in which you can go in and kind of give them, say $100, and they agree that in 5 years they will pay you back, a simple interest. It's usually a lower interest rate, but most likely you're going to get your money back. Once again, it's that risk factor. The counties, the governments are probably going to have money. If they don't have money, then getting your money back is probably the least of our worries. So that's why the bond gets a lower interest rate. All right, so cash would then be what you deposit into a bank account, certificate of deposit, treasury bills. Okay, and then cash investments will earn a very small interest. And one of the ways you can kind of invest is you can do it individually, make individual investments, or you can do what's called a mutual fund. And that way you would pool your money with a group of different people. Usually you give it to an investment banker, and they will make the investments for you. And then the profits or the money, the interest that comes back in, then gets split among the people based on how much money that they have. So if a person that put in $100 gets $2 back, a person that put in $300 would get $6 back on top of it. Okay. So that would be a mutual fund. All right. So suppose back in 1900, a man invested $250 in stocks, bonds, and cash. How much would he have at the end of 2010? So stocks has an average return of 6.7%. And then you'll probably hopefully recognize this formula from 4B. So 250 times 1 plus 0.067 raised to the 110 means his $250, if he put it in stock, would be worth $313,347.44. Not a bad return. If he'd gone with bonds at 1.7%, so you'd have 250 times 1 plus 0.017 raised to the 110th, sorry about that, he would have $1,596.78. That is a huge difference in the amount between 6.7% and 1.7%. So the two things, sorry about that, the two things that really matter when you're doing investments is interest rates and time. Okay. And cash are 0.7, and that would give him a whopping $538.50 after 110 years. Okay. All right. Couple definitions. Liquidity. It's how easy can you get to your money. Okay. If I have cash, or if I have a bank account, or I can just run to the ATM and get the money, that is said to be liquid. It's easy to get to. I can use it if I need to. Sometimes people have a lot of money on paper, okay, but it's hard for them to get to. For example, if they own a lot of land, well, the land may be worth a lot, but they're hard-pressed to get money because in order to get money, they would have to sell the land. Same thing if you had it in, say, art. Let's say you have, $10 million Van Gogh painting hanging on your wall. Well, you've got $10 million. The problem is if I need some money quickly, I'm going to have to take the Van Gogh down, find somebody to sell it, find somebody to appraise it, somebody to verify it's the real thing. It's not very, it's not very liquid. It's hard to get money out of the Van Gogh because there's a lot of time and effort it takes into selling it. So one of the things you've got to be careful is, can you get your money out? For example, if I have it in a CD, usually CD, I guarantee the bank that I'm going to leave it in there for a certain amount of time. It's a little harder to get to. Risk. Every investment has some kind of risk. It's always a balance. Okay. If I do safe investments, I'm not going to get any interest return. Okay, so that was our, if you notice in the cash from the last example, very low risk, 0.7% interest. The flip side is important. If I have somebody come to me and says, hey, I've got this company that's offering 30% interest, well, that's a lot of interest, tells me there's a lot of risk. Okay, I am not touching something that's offering 30% interest because chances are they're probably going to go out of business. Okay, so stocks and bonds are a little more riskier, so you kind of want to balance. And then how much is the return? Once again, high return means more money, also means more risk. Everything is in some kind of balance. All right, so you can go ahead and read through these. Okay, historical returns, that would be your Dow Jones average. It's the largest 30 companies. Financial data, anytime you want to invest, I would recommend going through a broker or a bank or somebody that knows what they're doing, because it can be a little nerve-wracking because you're dealing with your money, but also you want to make sure that you do it right. And then you've got capital gains on stock, or you could lose money, and you can get your dividends. All right. So if you go with a bond, there's the face value of the bond, which is the price that you must pay. There's the coupon rate. It's the simple interest that they promise to pay, and the maturity date is the date on which they promise to pay. Okay, so for example, I may go down, let's say a bond gets passed to build a new school here in Pitt County, and I could go down and say, I want to put $500 on a bond, and they'll say, we will give you 4% interest and we will pay you back in 3 years. And we could go back to one of the original problems and figure out how much interest I would have. Okay, but it's very kind of, that would be very simple. And of course, things are not always simple. So there's a secondary bond market. So let's say, 6 months later, all of the bonds have been sold, so the government is not selling any. You can actually sell your bond if you want money on your hand. If you need to get money, you can sell bonds to somebody else. It's called a secondary bond market. You may lose some of the money you would get over the time. So if I had $500, somebody may offer to pay me $520 for it. Well, I'm going to lose money in the long run because I would get more than $520 at the end of it. But sometimes you need the money right now. Sometimes they'll give you a pretty good rate. So that is where the current yield comes in. So current yield is defined as the amount of interest it pays each year divided by the bond's current price, not the face value. Okay, so if everybody decides this is a pretty good deal and they're all trying to buy the bond, it can actually drive the prices up. Same thing, if nobody wants to touch it, nobody's going to touch it, then that's going to drive it down. Okay, so if I have a $1,000 treasury bond, has a coupon rate of 3.5% and a market value of $1,050. What is my current yield? So we're going to take our 1,000 and we are going to times it by 0.025. So I would get $25 in interest for the year off my $1,000 treasury bond. Well, if I take that $25 and I divide it by the market value, which is $1,050, I would get a yield of about 2.35% yield. Okay, so that would be my percent yield. So that would tell me whether or not it would be worth to sell the bond. All right, and then just kind of the last thing, if you would like to read through this, here are all the different things that you should know when you are investing in the stock market, from the price changes to the volume, money cap, the dividend, the shares, highs and lows. Okay, so if you are looking to investment, I would go ahead and read through those, and once again, find somebody that knows what they are doing, because unfortunately, bad investments usually give you little to no return. All right, and that is everything for today.